is, no one can predict the future price. Predicting price movements of a single option or a position with multiple options amid the dynamic market changes can be quite challenging. Vis-a-vis or comparatively with stocks, it's quite simple. You can actually visually see if the stock value is rising or falling, but with options it's quite different. Options pricing is influenced by a variety of factors, making it quite difficult to really understand what's affecting their value. And as a result, trying to predict the price of an option strategy just doesn't work. And the bottom line is that options don't move with the stock price. There's a number of things that are affecting the options price, and it doesn't always move with the stock price. So when you're looking at when you're in the live market, you're trading a strategy. So technically, you see the market moving in your favor, but you still see that your position is losing value. You just can't understand what is affecting your prices. That really gets really frustrating. And it's important, therefore, to understand these factors, to understand the Greeks that affect the options price, so that you don't find yourself in that situation. And as I said, it's important to understand what factors make up options prices to be able to do just that and not get frustrated when the price, or avoid that situation, that frustrating situation when the market's moving in your favor, but the value of your strategy, the value of your investment is not showing the same result. Now, as options trader, we frequently refer to the delta, gamma, vega, and theta of our positions, or of our options positions, and collectively these are known as the Greeks. And they measure, or these measures indicate, an options price sensitivity to specific factors. For example, delta is related to the spot price, how the change in the price of the underlying asset affects the options price. Similarly, with gamma is concerned with the change in delta due to the spot price. Okay, and we'll come to the details in subsequent slides, but just as an overview, I want to show you how each of these factors that influence the options price are defined under the Greeks. So theta looks like the time value, vega the volatility, all important volatility that we constantly look at, and which defines our edge as far as options trading is concerned, and rho, which is concerned with interest rates. However, it's essential to clarify a common misconception. The Greeks do not set the prices. They don't determine the price of the option. Instead, they highlight potential price changes in options due to shifts in stocks, or the price of the stock, implied volatility, and time. So the Greeks are predictive, not determinative. They suggest how an option price might adjust based on various market movements. They only reflect what could happen. So think of them as levers. Alter one aspect and you can anticipate a corresponding reaction in the options price, and depending on how that one aspect changes, the options price will change. When there is a combination of these levers, that's when things get a little complex, but it's important to therefore analyze each aspect independently so that you can understand as a collective how the whole thing is working. But before diving into the Greeks, let's really explore the foundation of options pricing. And building on what we learned so far, think of options pricing as divided into various categories, which will show you the way for a deeper understanding of the Greeks. Now, in a previous video, we looked at intrinsic value versus extrinsic value. We looked at concepts such as in the money, out of the money, and at the money options. And just as a recap, an option is fundamentally broken down into two primary components: intrinsic value and time value. Now, intrinsic value refers to the immediate value of the option if it were to expire right now, right? And it's derived from the difference between the spot price and the strike price of the stock and the option strike price, right? So, as an example, imagine you have a call, a 50 rupee call, and let's say the current market price is 55. Then there is a 5 rupees of intrinsic value, I won't say IV because that's something different, in that strategy, in that position. Very simply, you can buy the stock for 50 rupees because of the call and sell it in the market for 55 rupees, and that's where the profit will come from. The second component of extrinsic value, this is to do with time, which really lands up being the stumbling block, the challenge for many people. So while intrinsic value is relatively straightforward, time value incorporates the fluctuation in the changes in the options pricing in addition to the movement of the underlying stock. So intrinsic value is straightforward, movement in stock price or the underlying price, and the corresponding change in the options price, whereas the time value is the additional component that we need to look at, right? So time value incorporates all the time factors, such as time until expiration. So generally options with more time until expiration carry higher value because there's ample opportunity for the contract to prove profitable. There's time for it to move into a profitable area to go in the money. And conversely, if options closer to their expiration date tend to be of lower value, assuming of course that all other factors are constant. Now these fundamental aspects of intrinsic and time value, they make up the core pricing mechanism of options and pave the way for our deeper exploration, deeper understanding into how the Greeks influence options pricing. And we look at this as we progress. Now, volatility really is the keystone as far as our discussion and practices around options trading is concerned. So whether you watched our previous videos on this or this is your first encounter with income option, I want to emphasize that mastering volatility is paramount as far as options trading is concerned. So when you look at the world of options and options pricing, volatility signifies that when markets experience high volatility, options prices also elevate or also rise across the board. So the increase in volatility impacts all prices, calls, puts, and everything in between. High volatility equates to higher options prices because, akin to a rising tide lifting all boats, a volatile market with its wild swing enhances the probability of each strike price being hit. So if you have a 50 strike or a 60 strike or a 70 strike, if your market is moving around a certain price, let's say 60 rupees, then the chances of a 70 being hit and a 50 being hit are equally high. As against if you have a low volatility market, again around 70, and it's moving around the 60 rupee price point, the chances of a 70 or a 50 being hit are relatively low, which is why as volatility rises, the prices of all options tend to rise. Okay, now the final factor which influences an option's value is the interest rate. But as far as we are concerned, it's not really our primary focus. It's worth an overview, but it's not really a factor that influences our style of trading. Rho or interest rate affects options that have distant expiration dates. So much like time to maturity and volatility, the further out the contract expiration is, the more significant the impact of interest rate fluctuations on the options value will be. Consider it in terms of the advantage of holding an options vis-a-vis the stock, right? The amount of capital that is required in each of these cases is significantly different, and therefore the change in interest impacts the lower margin investment, which is an option. But in our situations here at the income option, and actually for most traders operating within the 60-day trading window, the impact of interest rate is actually negligible. And because of this, while we don't really go deep into understanding Rho as a primary Greek, it's worthwhile just to note that it's there, and the potential influence on the price and on options trading in specific scenarios, right? So when you have a longer term option in place, in specific scenarios, let's just put it at that. Now, having outlined the basics of options pricing, let's look further into the Greeks, and we link them back to the foundational concepts that we've just looked at. Essentially, options pricing can be segmented into two chief categories, and within this framework, we will look at the Greeks themselves. So we identify four principal Greeks: the delta, the gamma, the Vega, and the Theta. We looked at Rho, as I said, we acknowledge it, it's there, we know it, it talks about interest rates, but it doesn't really impact the valuation as far as we are concerned. We're looking at shorter term strategies, and therefore it will not be our main focus over here. So delta illustrates the relationship between intrinsic value, It reveals the amount of profit that your position has, that you're set to make for a specific strike price. Okay, and it depends on the movement of the underlying stock. So it is a function of the spot price or the stock price and the strike price as well. So as we proceed, we will explore delta in more detail, and we look at various examples as well. Gamma, while not directly tied to the specified value like delta, plays a crucial role because it helps us understand the rate of change or the acceleration of delta. So in simpler terms, gamma helps us determine how much profit will be accrued, will we stand to make with each subsequent rupee increase. Okay, again, we look at the details and how it actually works, but just to know that gamma is actually concerned with delta. Well, delta is concerned with the spot price and strike price, and it measures typically the intrinsic value of the position or of the option. Now, Vega is relatively easy to remember. So think of V for Vega, V for volatility, and it shows you the impact on the option price for a 1% change in volatility. So as the volatility changes, what is the impact on the options position? So it indicates how the value of the option would change should the volatility increase or decrease by 1%. Okay, and then theta is time value. Again, T for theta, T for time. Very easy to remember. That shows us how much the value of the option decays daily as it goes closer to expiration. So every day, what is the value that the option gains or loses as it goes towards expiration? Now, always gains or loses depends on which side of the trade you're in. Okay, so but it basically, as a buyer, how much are you losing every day till expiration? So as the clock ticks down, basically the value of the option goes down, and especially true in the last few weeks to expiration. And lastly, we have so I'll just put down daily loss in value. Okay, and lastly we have rho, which is related to interest rate, which is, as I mentioned, and we won't really look at this in depth because it's very low impact as far as short maturity options are concerned. So as we look deeper into these things, I'll show you how, and I'll shed some light on each aspect, delta, gamma, theta, and Vega, and we will look at examples and we look at live pricing relative at the time of this video. Okay, and the whole idea is to show you in real time how these factors are determining our positions. So let's clarify things a little bit more, and let's look at delta in detail. Now, one of the primary Greeks as far as options trading is concerned, and you'll frequently look at this in options trading context. And delta is absolutely important because it predicts how much an options price is anticipated to move based on 1 rupee increase in the underlying stock. So as the stock increases in value, what is the change in the price of the option? Now, you have to note that delta is always predicted or is depending on 1 rupee shift upwards. Okay, whether you're dealing with a 500 rupee stock or a 2 rupee stock, it doesn't matter. It has to deal with a 1 rupee and only 1 rupee, and the move has to be up. So as a result, call options have a positive delta ranging between 0 and 1, meaning that a movement, one uptick in stock always benefits long call options, and put options have a negative delta between 0 and -1, showing that there is a negative relationship, and that as the market goes up, the price of the put options goes down. Now let's look at gamma. Gamma in the context of option trading. Remember, gamma is basically tied to delta, and it plays a crucial role as far as how the delta changes. So change in delta due to the spot price. Okay, in simple terms, gamma indicates the rate at which delta changes in response to 1 rupee change in the stock price. So if you look at delta as the speed of change, representing how much money you make or lose when the stock price changes, gamma should be thought of as the acceleration. Okay, and therefore options with higher gamma are more reactive to variations in the underlying securities stock price. So options with a higher gamma will react more to the change in the stock price. So put it very simply, think of gamma as the additional profit or loss for the next rupee change. So as the price changes, not only does the price of the options change, but also delta changes, and therefore the next rupee change has a higher impact on the options price as well. Okay, and we'll see this in live examples in the next slide. But to put it very straightforward, think of gamma as representing the additional profit for the next rupee change. Options with highest gamma, as I said, are most responsive as far as changes in spot price are concerned. Okay, so in the next slide we'll jump into the broker platform and look at live examples of strategies and how the delta and gamma are set up. Into the broker platform very quickly, we'll go to the builder section and we'll run a simple strategy of the long call. So we're looking at the long call at current market price, at the money strike price of 19,600, current market price being 19,543. We're looking at the Nifty with an expiry of 26th October 2023. Why the Nifty? Well, that's just the default and something that we're very active in here at the income option. So when we look at this chart, let's look at the risk profile that it shows up. You see that you've purchased this call for 60 rupees, the 19,600 call for 60 rupees. And this throws up this profile that we're looking at. Now, when we go down here, you'll see the position delta at 37.39 rupees. Now, 37.39%, which, as you know, in terms of actual numbers is 0.3739, and as we saw in the previous slide, the delta for a call ranges between 0 and 1, and we'll see subsequently for the put option as well, which will be in the negative. So as the price goes up, your the price of your option will change by 37.39 paise, okay, or 38 paise to round it out. And likewise, we also have the delta here. So every time the delta moves up by 37.39%, the delta itself will change by 16 paise. So you'll see that you'll notice that when the market moves up a little bit, then the delta changes, but so does the price changes, but so does the delta. Okay, and we can see that here in the Greek section itself when we look at the Greeks in rupees. So Greeks in rupees will show you 18.69 rupees, which means that for this strategy, with a 1 rupee movement up in price, your mark to market will increase by 18.69 rupees. How is that calculated? 18.69 is basically the number of units that you sold in the lot, so 50 units to a lot, 50 units multiplied by the delta. So when you see the delta at 37.39, so very roughly 37.39 into 50 will give me this 18.69. That's what you're seeing here in terms of the delta. As you can see, 18.69 right over here. So that's how delta is happening, and the gamma is changing with with the increase in price, and that changes by 0.08 paise, or rather that changes the delta by 0.08 paise. So as the price goes up 1 rupee, the price of the option changes by 18.69 rupees for this strategy. So the acquisition price multiplied by the lot size, and the delta itself changes by 8 paise. So hopefully that's clear as far as delta and gamma is concerned for a call option. I'm going to reset this and set up a very simple put as well. So not shorting a put, but we'll go ahead and long a put and see how that works out. Again, at current market price, I'm not going into too many options over there. So 19,500 put, we bought it for 81.05 paise. Now, as you can see, this is the profile that comes up, and very quickly the delta is in the negative. So you lose 45 paise for every rupee that it moves up. In terms of rupees, that translates very quickly into 22.88 rupees, and the gamma is at 9 paise. So every time the price of the underlying, the price of Nifty goes up 1 rupee, your option value, or the value of this strategy, will move by 22.88 rupees downwards. That is, there's an inverse relationship, and the delta itself will change by 9 paise. So hopefully that clarifies delta and gamma for both a long option as well as for a short option. Okay, so now let's look at Theta as far as options pricing is concerned. Theta, also known as time decay, is really looked at as a double-edged sword as far as options are concerned. It's often dubbed as enemy number 1 for options buyer, while conversely, It's the best friend as far as option sellers are concerned. Now, at the income option, we look at, since option sellers benefit by leveraging theta, we at income option are very concerned or very focused as far as theta is concerned, and we want to use it to our advantage as far as in as many situations as possible. So understanding it very simply, theta quantifies the rate at which the price of call and put options will decrease daily as an option edges closer to the expiration date. Okay, so it basically represents the amount the price of option will decrease by, and you'll see that amount listed in as we go through the broker platform. You'll see the amount itself listed there, and this amount is reduced from the price of the option every single day as it approaches expiry. Okay, and you'll notice that as it comes closer and closer to the expiry, this value keeps increasing as well, of course keeping other things constant. And as I said, it's enemy number one as far as options buyer is concerned, and it is the best friend for us as option sellers. Now, option sellers often prefer this inherent wastage aspect. We all know that as far as options are concerned, options are wasting assets, and we want to exploit this situation in as many people as possible. Okay, and we'll look at this. We'll look at examples of this in the broker platform. But just so you know, it is enemy number one as far as your buyers are concerned, and it's your best friend if you are a net seller of options. And then the next concept on our agenda is the Vega, right? And V is for Vega, V is for volatility. It's a particular favorite for many traders, and particularly for me and for us at the income option. It has a vital role as far as realizing profitability or profits in options trading is concerned. You see, Vega is concerned deeply with understanding the correlation between implied volatility, historical volatility, and options pricing, which is crucial as far as your trading business is concerned and your trading activities are concerned. Now, Vega reflects the change in the price of a call or put option with every 1% change in volatility. And the volatility, of course, is to do with the underlying stock. It is based on a 1% shift upwards in implied volatility, showing how much traders might gain or lose, assuming, of course, that all other variables remain constant and only the implied volatility goes up. Now, remember, it does not affect the intrinsic value of the option. It only looks at the extrinsic value of the option. Now, it's crucial to recognize that implied volatility is a pivotal element in an option and its pricing model, because it is the only unknown, right? Delta, Vega, delta, gamma, and theta are known. Only the implied volatility is the unknown. Okay, and because of this unknown situation, it is where our edge comes across, right? So the option market is generally knows about the factors that determine an options price. So the current stock price, strike price, intrinsic value, time until maturity, interest rate, everything is known. The only uncertainty lies as far as the future volatility of the stock is concerned. And as I said, this uncertainty is what gives the traders an edge and advantage, and it becomes a crucial component for success as far as trading options is concerned. And it changes into an opportunity to earn profits, and it is fundamental to the advantage that we have in the market. So going deeper into implied volatility, it gauges how much the stock is projected to fluctuate in the future. So remember, it's an implied volatility. How much are we expecting the volatility to change? The options market or market participants decide this volatility, and it's determined by the demand that we see in the market as such. Okay, it is, as I said, the most critical component, and it is the only unknown. Let's see how the Vega and Theta looks like in the broker platform. So going back into the builder, we'll look at setting up a long call, just like before, for the default at the money strike for the next expiry. And as you can see, this is the profile that comes up, and right over here you'll have the Theta 738.76 with a Vega of 947.28. Theta, as you know, is the amount your strategy is going to lose every day. Now, as it exists over here, it doesn't make too much sense. So 738 does not make sense. You need to convert this into rupee. Luckily, your platform does that for you. So when you go into the Greeks right over here, you can convert that. You can check this box and say Greeks in rupees, and that you'll get 369.39 rupees lost every day that you hold on to this strategy. Okay, so remember, this is a long call. You are a net buyer, so therefore this is a net wasting asset for you, and every day you're losing 369.4 rupees. And this is translated here on the platform on the risk profile diagram itself. So if I was to move this next n days from 0 days, that is current today, to 1 day down at the same price, the value of your strategy moves, as you can see, from 571.79 or 75 after it's been refreshed, 571.75 to 144 rupees. So that is roughly the amount of the theta movement. This is just pure loss in the time value, right? So you're not moving the price of the underlying asset at the same price. Your value moves from 571 to 144. You're losing the $300 every day, more than $300 every day, right? And likewise for Vega. Vega is the volatility index, and it shows what your percentage change in volatility will bring about as in the value of your asset as well. So when I jump over, actually before I go into Vega, I want to show you. No, actually we'll do that subsequently, because I'll have to set up the strategy again. So Vega is at 473.57, which means as the IV changes, as the implied volatility changes, the Vega changes as well. So the value of your asset, your position, changes by 473.57 rupees as the volatility changes. Again, this is seen in the payoff chart. If I move this back to 0, and you'll see that your current market price, you're currently at a PNL of 0 rupees. But if I move the IV by just 1%, or let's say, sorry, it just moves in the breaks of 5, so let's say it moves by 5%, the value of your position changes from the 0 value to about 800 rupees. So there's that jump in value just because of the movement of your of the IV by 5%. So that is shown in your platform itself. Now, if you jump back into the opposite side of this strategy, which is the shorting call, right? So if I just simply go here and I turn this position around, and instead of buy, I do sell. Let's see what that looks like. Okay, so we modify the position to create it into a short call position. Okay, and you will quickly see how the theta value now is positive. So every day that goes by, your value of the stock is increasing from 0, from where it is right now. It'll keep pushing up and up and up till it reaches this maximum profit that you have of 3,000 rupees. Okay. And of course, this is showing at 5%. I'm going to reset this to 0. So this is going to stay where it is. As the value moves up, as theta goes up, it's going to go higher and higher towards this 3,000 rupees. In terms of rupees itself, the theta is 369. It's the polar opposite of what we were doing when we went long. So whatever you're losing as a buyer, you're gaining as a seller. Okay, so hopefully that makes sense. Likewise for volatility, remember, volatility makes sense when you are when you're in the money, right? So when you are this Vega is now negative, so the payoff chart will accordingly increase. So now, since you're in the money, you want that volatility to be low. You want it to stay low because you don't want too many high movements. Because of increase in volatility, the value of your strategy is going to go down. We'll see that in a minute, right? So we move this IV to 5% up, and immediately the value of your position drops, and this drop to 804 rupees is because now it is likely that your strategy is going to end up in the money, or rather out of the money at the end of the day. So it can become positive. The strike price can become positive, and therefore can get exercised, and thereby putting you thereby creating an assignment on you, and you having to then take in that loss. Okay, so hopefully that gives you examples on the theta and the Vega, both for long positions as well as short positions. So being a buyer as well as being a seller of options. So there you have it. Options prices have intrinsic value, and they have extrinsic value. And the gammas reflect the value that lies within the options price. The spot price and strike price is delta and gamma. Volatility, of course, is Vega. V for volatility, V for Vega. Time is shown by theta, T for theta, T for time, and the interest rate comes from rho. As long as we understand this, we understand what impact these factors have on the price of our strategy, on the price of the options that we're holding. As we said, rho is indicative, only applicable if you have long-term options in your strategy, but the other four of the delta, gamma, vega, and theta are absolutely important. And of all these aspects, volatility is the only unknown, and which is what gives us that edge that we've spoken about, the advantage in the market that we can take advantage of and create profits from our strategy, from our trading. But remember, as I said before, Greeks are just snapshots. More important is the impact of volatility, the only unknown as far as we are concerned, and future time decay. So through these examples, we've shown the various Greeks, and hopefully this has created a deeper understanding of the Greeks and how they impact the options price and the price and the value of your strategy, of your option strategy, and how knowing this can create an advantage for you as far as your trading business is concerned.